Welcome back to the deep dive. Today, we're going to rip through a mountain of your financial research because, let's face it, you want the shortcut.
You want to know how to stop just putting money aside and actually start making that money work for you.
Exactly. And you sent us a really comprehensive stack of sources. I mean, we're talking dozens of Q&A responses covering, well, everything from the absolute basics of investing to the really messy, powerful forces of macroeconomics.
It's like a perfect mission for us. Because the listener here, they're not just looking for definitions from a textbook, are they?
No, not at all.
They need a foundational framework, something that gives them the confidence to go from being let's say, a passive saver to a genuinely strategic investor.
So our job is to pull out the essential stuff, the high-impact knowledge points.
The nuggets. The things that are really going to move the needle on your long-term financial goals.
Okay, so let's start with the most fundamental truth, the one that really dictates this entire conversation. If your goal is long-term wealth, what is the single biggest, most persistent threat to that goal? We have to name the villain right up front.
We do. And the villain is, it's pervasive, it's subtle, and it is always there. It's inflation.
Okay, inflation. We all get that. It means prices go up.
Yeah.
But let's make that real. Why is just keeping your money idle, say, in a checking account earning basically nothing, why is that the primary enemy here? Why isn't it something more dramatic, like a market crash or picking the wrong stock?
Because a market crash is an event. Inflation is a process. It's a constant erosion. It attacks the very core function of money, which is its purchasing power.
Right.
Saving is all about cash flow protection. That's the job. You put 100 rupees in, the 100 rupees will be there tomorrow. But if you keep that money uninvested, especially over, say, a 20 or 30-year horizon, your sources are crystal clear on this. It fundamentally loses its real value.
So you have the same number on the banknote, but what it can actually buy.
What it can actually purchase. Groceries, fuel, a house, tuition, all of that has shrunk. If you're thinking long-term, just saving is a guaranteed way to fall behind. It's a guarantee of failure, really.
That makes the distinction between saving and investing so incredibly clear. Saving is security. It's about maintaining the absolute number, the capital. But investing is the explicit choice to put that money to work with the, aggressive intent of earning a return that will outpace that silent killer, that erosion.
It is the essential countermeasure. In fact, it's the only real countermeasure.
Yeah.
And the second you accept that investing isn't optional, that it's a necessity, that's when you have this aha moment about the sheer power of returns.
The magic of compounding.
The magic of compounding. And your sources gave us a fantastic case study to show just how powerful this is.
Let's use that data point because it is just so compelling. So imagine a huge life goal. You need a corpus of, say, 2 crores in 30 years. A pretty standard retirement sum for many.
That's a significant goal. Yep.
Now, if you only save, meaning the money just sits there, earning zero return, your required monthly contribution it's monumental. You'd need to put away 55,555 rupees every single month.
Think about that. That is an enormous, almost unsustainable pressure on your current income.
It is. But now, watch what happens when you introduce that magic of compounding. Same goal, 2 crores in 30 years. But this time, you invested. Let's say in something that yields a, frankly, pretty conservative 10% annual return. The entire calculation just flips on its head.
The required monthly contribution, it just collapses. It drops all the way down to 8,847 rupees.
That's profound. It's nearly an 85% reduction in the amount of your own money you have to shovel into this goal every month.
And that's the insight right there. That's the whole point. The returns your money earns effectively free up your own savings. They dramatically reduce the principal you have to contribute from your own pocket.
It totally shifts the burden of building that wealth.
It shifts the burden from your paycheck to the market. Think about that difference. 47,000 rupees every single month.
That's money you can use now for your quality of life, for travel, for a bigger house.
Absolutely. Simply because you allowed time and money to do the heavy lifting. That exponential growth over 30 years where your returns start generating their own returns, that's the engine. That's everything.
So lesson 1 is established. We have to invest to fight inflation and to reduce our own financial burden, which of course leads us right to the next logical question. If we have to invest, what are we investing in? We need a map of the landscape.
Let's draw that map.
Okay, so we're moving now from the why of investing to the what. We need to understand the fundamental tools. Our sources group all these investments based on their shared characteristics. So let's start with the basic definition. What exactly is an asset class?
An asset class is, to put it simply, a family of investments, and all the members of this family, they share similar DNA.
DNA in what sense?
They have similar risk and return characteristics. And really crucially, they tend to respond in a similar way to big market and economic events. So, when the economic tide comes in or goes out, they all tend to move together in a somewhat predictable pattern. That's why we group them.
And the sources give us two really broad classifications here. We have financial assets and physical assets. Let's start with the financial side.
Okay, so financial assets represent a claim that you, the investor, have on future benefits. You aren't holding a physical thing in your hand. You're holding a promise or a legal right to something.
So what are the big families here?
The major classes are equity, debt, and cash or cash equivalents. So, for example, if you have a bank deposit, the bank owes you your money back plus interest. That's a debt claim.
And if I own a share of a company?
If you hold an equity share, the company owes you a tiny piece of its future profits. It's a claim on their success.
Okay, that makes sense. Then on the other side, you have the physical assets, the tangible stuff.
The tangible stuff, exactly. Things like real estate and commodities, and the classic example is always gold.
So what's the key difference?
Well, a physical asset doesn't inherently represent a legal claim on a future income stream in the same way a share or a bond does. This distinction is really important for understanding how they generate returns. So let's deep dive into the DNA of each of these major classes.
Perfect. Let's start with the big one, equity. This is the growth engine for most people's long-term portfolios. So what drives the return and where does the risk really come from?
Equity shareholders, people who own stocks, they benefit from a dual source of return.
Okay.
The first source is dividends. These are just cash payments that a company might pay out from its profits, but, and this is important, they aren't guaranteed, and they're not usually the main reason people buy stocks for growth.
The real power is somewhere else.
The real power comes from the second source, the appreciation in the value of the shares themselves. If the company does well, if its earnings grow, if the market believes in its future, the share price can rise exponentially. That's where the real wealth creation happens.
But the moment you make the share price the main driver of your return, you are inviting a huge amount of risk into the picture.
You absolutely are. The unique risk for equity is high volatility. Share prices fluctuate constantly. Second by second. They move based on company performance, market sentiment, a piece of news.
So if you're forced to sell at the wrong time?
If you have to sell during one of those frequent dips, you could easily realize a loss. And this links directly back to what we said about time. You need a long investment horizon to ride out that volatility and capture the long-term upward trend.
And the sources also point out that not all equity is the same, right? It's not one monolithic thing.
Exactly right. Even within this one asset class, there are different layers of risk. Your sources distinguish subcategories, like large-cap stocks.
So these are the big established companies.
The household names, yeah. They have established markets, more stable earnings, proven track records, and they typically offer greater stability and less volatility compared to, say, small cap or micro cap stocks.
Where the potential for growth might be higher, but so is the risk of them flaming out.
Precisely. The risk-return trade-off is right there.
Okay, let's pivot to the other end of the spectrum. Debt. This is often seen as the anchor of a portfolio.
Right. So debt instruments, bonds, debentures, FDs, they represent the borrowings of the issuer. That could be a corporation, a bank, or a government.
And the source of return is much more straightforward.
Incredibly straightforward and usually reliable. It's regular income in the form of interest, or what we call coupons. You are lending them money, and in return, they contractually commit to paying you a fixed stream of payments until a set date, the maturity date.
So with equity, the risk is that the market just doesn't like your company's performance. But the core risk for debt is totally different. It's default risk or credit risk.
That's it. The day-to-day market price volatility is usually much lower. But the existential risk is that the issuer just fails. They can't pay the interest they promised, or, even worse, they can't repay the principal amount itself at the end.
So if you lend money to a shaky company, that's your number one concern.
It's your primary concern. And we'll get into how this is measured later, but for now, the key idea is that the financial health of the entity you're lending to, what we call their credit rating, that is the central question in the debt market.
Got it. Okay, now let's jump back to cash and cash equivalents. You said this barely qualifies as an investment engine. It's more of a parking spot, isn't it?
It is exactly a parking spot. The objective here is totally different. It's all about the preservation of the absolute value of your capital
Hmm.
and ensuring high liquidity.
Meaning you can get your hands on it immediately?
Instantly, with no penalty. They earn only a nominal return, a return so low that it basically guarantees you will lose to inflation over time. So we're right back to our first lesson.
So you're trading real returns for absolute safety and immediate access.
That's the trade-off.
Okay, let's pivot to the physical assets. Let's talk about commodities, and specifically the one everyone thinks of, gold.
Gold and other similar commodities are what we'd call purely growth-oriented assets. They give you absolutely no periodic income.
Right, a bar of gold doesn't pay you a dividend.
It does not. A lump of metal sits there. So 100% of your potential return is derived only from the appreciation in its price. And that price is driven by external factors: global demand and supply, geopolitical risk, and its traditional role as a hedge against inflation. It can perform a very specific function in a portfolio, but it's not going to pay your monthly bills.
And finally, real estate. The returns here can be dual. You get rent and hopefully appreciation, but the big catch often seems to be getting your money out.
That is its defining feature. The unique dominant risk is profound liquidity risk.
Meaning it's hard to sell.
It's very hard to sell quickly at what you perceive to be the right price. You can decide today that you want to sell your stocks or your government bonds, and that transaction is done in seconds. You cannot do that with a property.
No, and it's a long process.
It involves agents, finding buyers, legal searches, paperwork. It can take months, sometimes longer. This lack of rapid tradability means your capital is fundamentally tied up, and that illiquidity demands a long, patient investment horizon.
So we pull all this together and look at what the sources call total return volatility, which includes both that periodic income and the changes in value. The difference between the asset classes is really stark.
It's night and day. Debt instruments, because their main source of return is that fixed, predictable interest income, they have less volatile total returns. You know what you're getting, more or less.
But equity.
Equity, on the other hand, is driven almost entirely by capital appreciation, a variable that changes every single second the market is open. And that results in highly volatile total returns.
And the practical takeaway for you, the listener, is what we keep coming back to.
It's the golden rule.
These volatile assets, like equity, are only appropriate if you can promise them one thing: a long investment horizon. You need that time. You need it to smooth out the inevitable dips and capture the long-term trend of growth.
If your goal is 5 years away, putting all your money in equity is a very dangerous gamble. If it's 30 years away, it's an almost necessary engine for growth.
So we've laid out the assets. Now for step 2, and this is maybe the hardest step for people emotionally, it's accepting the unavoidable truth. Every single investment demands a trade-off. If you want the potential for high returns, you simply must accept higher risks.
That is the iron law of finance. There's no escaping it. The potential for a return is precisely what compensates you for taking on that risk.
It's not a free lunch.
Never. I like to think of it like a high-altitude climb. You only get that incredible panoramic view because you accepted the risk of the thinner air and the chance of a fall. If anyone ever comes to you promising a guaranteed 20% annual return with zero risk, you run away. They're selling a fantasy. So what we need to do now is categorize the key risks we found in the sources, because each one requires a very distinct management strategy.
Okay, let's start with the most obvious one: risk to capital, which is often driven by what the sources call business risk.
Right. Risk to capital is just the simple possibility of a partial or even a complete erosion of the principal amount you invested. The classic equity example is you invest $100 in a share and the price falls to $50. You've lost half your principal. Simple as that.
And often that fall in price is because of business risk.
Precisely. Business risk is specific to that one company or its industry. Maybe there was a sudden spike in the cost of their raw materials that crushed their profit margins. Or maybe a competitor came out with a new technology that made their product obsolete.
It's an internal failure point for that specific business.
It is. And the management strategy here, which is fundamental to all portfolio construction, is diversification.
Don't put all your eggs in one basket.
It sounds like a cliche, but it's the most powerful tool you have. By holding a diversified portfolio, you ensure that if one of your investments gets hit by a specific business risk, the success of your other investments can offset that loss.
Okay, risk number 2 is liquidity risk, which we've already tied very closely to real estate.
Yes, but it applies elsewhere too. Liquidity risk is the consequence of your funds being locked in for a fixed period. The money isn't readily available. And if you need to get access to it before the agreed upon maturity date, let's say you need to break a fixed deposit early,
You pay a penalty.
you almost always face a penalty, like getting a lower rate of interest. That penalty is the compensation the bank or institution extracts for the inconvenience. You broke the deal, and now they have to adjust.
All right, let's dedicate some serious time to the core risk of the fixed income world, default or credit risk.
This is non-negotiable for anyone investing in bonds or any kind of debt. It is the risk that the issuer, the borrower of that bond or debenture, simply fails to honor their contractual obligations.
So they just don't pay you.
They default on the promised interest payments, or in the worst-case scenario, on the final principal repayment itself. It's a risk of a true and total loss of your capital.
And the market has a way of quantifying this, of measuring it through the credit rating.
Yes. Independent ratings agencies like Moody's, S&P, Fitch, they objectively assess the issuer's financial health and their likelihood of meeting all their debt obligations. That rating is the market's shorthand for the level of risk.
And this is where that trade-off principle becomes crystal clear, isn't it?
It's the clearest example there is. A bond issued by a company with a lower credit rating, what people sometimes call a junk bond, that indicates higher default risk. To attract investors, it must pay a higher coupon, a higher interest rate, compared to a highly rated super stable company's bond of the same duration.
So if a risky company is offering a 12% bond and a very stable one is offering 5%, that extra 7% isn't a gift.
Not at all. It's the market's price for uncertainty. It's the premium you are being paid to take on a much greater risk of default. The compensation has to reflect that uncertainty.
And on the subject of safety, let's talk about the special case. Government securities, or GSECs.
Right. GSECs, like U.S. Treasuries, pay relatively low interest rates. But it's because they are considered to carry no credit risk or risk of default.
Why is that?
Because a sovereign government, theoretically, can always print more money or raise taxes to pay its domestic currency debts. So the risk of an outright default is seen as virtually zero. They are the financial benchmark of safety.
And the sources also note that for corporate bonds, the ones issued to the public, they have to be credit rated.
Yes, in many jurisdictions, that's a compulsory rule to ensure transparency and protect retail investors. You have to know what level of risk you're buying.
Okay, moving on to the silent killer we started with, inflation risk.
Right. And just to redefine it, this is the risk that your money, even after earning what looks like a decent nominal return, is actually worth less when you receive it.
Because the prices of everything else have risen faster.
Your purchasing power gets eroded. You might be thrilled to receive 1,000 rupees in interest, but if inflation was running at 8% that year, that 1,000 rupees buys far, far less than it did when you first invested the money.
And the sources say this vulnerability is highest in fixed return instruments. Why is that? Why are bonds and FDs the most exposed?
Because the contract is rigid. It's immutable. Your 20-year bond guarantees you a fixed payment stream, say 5% interest, and $1,000 principal back in the year 2045, that's locked in.
So if inflation spikes to 7%,
your real rate of return is negative 2%. Because the interest payment and the principal repayment are fixed in absolute nominal terms, their real value is steadily being degraded by the rising cost of living. In a high inflation environment, the system is rigged against the fixed income investor.
This is particularly damaging for people who are in the distribution phase of their life, like retirees.
Oh, absolutely. Retirees often rely on fixed income streams from pensions or annuities. If those income flows are fixed in absolute terms and the cost of living suddenly accelerates, their entire lifestyle budget is immediately squeezed. They have the least flexibility to earn more to offset it.
So how do we fight back? What's the management strategy against a force like inflation that we can't really stop?
Well, one way is through tactical allocations to assets that tend to do well in inflationary periods. That usually means things like equity, where corporate earnings can grow with prices, or commodities like gold.
But the sources point to a very specific financial product designed as a direct defensive weapon here.
They do, and it's a very elegant solution. They're called inflation index bonds, IIBs.
Let's really unpack how these work, because this is a fantastic concept.
Okay, so an IIB, which is typically a government security, is built specifically to adjust for inflation. It doesn't just promise you a fixed return. Both the coupon income you receive and the principal amount are adjusted. They're multiplied by an index ratio that reflects the official change in consumer prices.
So if inflation goes up by, say, 5%.
Then the principal value of your bond is also adjusted up by 5%. And the next coupon payment you receive is calculated based on that new, higher inflation-adjusted principal.
So you are never losing your real value. The IAB ensures that the purchasing power of your investment is maintained by constantly increasing the nominal value of the underlying asset. That is genuine protection.
It's the purest form of inflation protection you can find in the debt market. It directly removes that critical vulnerability of having fixed nominal payments.
Okay, let's tackle the fifth risk, reinvestment risk. This sounds a bit academic, but it can have a really big impact on your final nest egg.
It really can. This risk is primarily faced by investors who are receiving periodic cash flows from their investments, like bond coupons. Reinvestment risk is the danger that when you get those cash payments, you won't be able to reinvest them at the same rate of return as your original investment.
Can you give us a simple example?
Sure. Say you bought a 10-year bond that pays you a nice 8% coupon. Every 6 months, you get a cash payment. But what if, 5 years into that bond's life, the central bank has dropped interest rates significantly? The best available rate on a new, comparable investment might only be 6%.
So I'm forced to reinvest that coupon income at a lower rate.
Exactly. You're still accumulating your corpus, but the engine driving that accumulation is slowed down. You're not going to hit the final target you projected based on that original 8% return because a chunk of your money is now growing more slowly.
And that brings us directly to the big external force that drives this, interest rate risk.
This is absolutely central to understanding the bond market. Interest rate risk is the risk of adverse price movements in your existing bonds due to changes in overall market interest rates. And the relationship here is fundamentally inverse. This is the key insight you have to master.
Okay, let's walk through it again, slowly. Why do existing bond prices fall when overall market interest rates rise?
It's all about competition. Imagine you own a bond that pays a fixed 4% coupon. It's locked in. Now, if the central bank increases rates and new comparable bonds start coming onto the market paying 6%, well, why would anyone buy your old 4% bond on the secondary market?
They wouldn't. It's a bad deal.
They won't, unless you drop the price. You have to offer your bond at a discount, a lower price, so that the yield the new buyer receives, which is calculated based on that lower price and the fixed coupon, matches the prevailing 6% market rate. The price has to fall to make the yield competitive.
And conversely, if rates fall, my old 4% bond suddenly looks very attractive, and its price will go up.
You've got it. The price adjustment is what equalizes the yield with the prevailing market.
And how do we measure how sensitive a particular bond is to these changes?
We use a metric called duration. Duration measures the price sensitivity of a bond to changes in interest rates. And here's the practical takeaway you need. The higher a bond's duration, the greater its interest rate risk.
And longer-term bonds have higher duration.
Much higher. Because you are locked into that now unattractive coupon for a much longer period. That time horizon acts as a multiplier on the sensitivity of the price. If rates change, a long-term bond has to adjust its price much more severely to equalize its yield over its long life.
Okay, and finally, we have the big catch-all risk, market risk.
Market risk is the broadest, most systemic risk of all. It's the risk of losing value simply due to adverse price movements across the entire market. It's often in response to big geopolitical events or major economic news.
It's systemic.
It's systemic. It affects all investments where prices are set by the market equity, bonds, gold, real estate. It's the risk that the tide goes out for the whole economy. You can diversify away from a single company's business risk, but you cannot diversify away market risk. It affects everyone.
All right, we've spent a lot of time on the assets and the risks that come with them, but those things don't exist in a vacuum, do they?
Not at all. They're constantly being pushed and pulled by these huge external forces, the macroeconomy. If you're going to build a truly strategic portfolio, you need a playbook for how these forces shift the risk and return of everything you own.
Exactly. We already touched on this a bit. Different asset classes respond very differently to economic pressures.
That's right. You gave the example earlier. Commodities can do really well during periods of high inflation, but that same inflation tends to hurt corporate profitability, which is bad for equity. The drivers are completely different.
So let's start with the most fundamental measure of a country's economic health: Economic growth, which we measure by GDP.
Right. GDP is the total final value of all the goods and services produced within a country in a year. The rate of growth in that GDP is our core measure of economic health. But for you as an investor, it is vital to understand the difference between nominal GDP and real GDP.
Okay, so nominal GDP includes the fluff of rising prices, right?
It includes the distortion caused by inflation. So if a country's physical production stays completely flat, but prices for everything rise by 5%, nominal GDP will show 5% growth, which is, misleading.
It's not real growth.
It's not real growth.
Yeah.
Real GDP, on the other hand, is calculated using prices from a fixed base year. By stripping out the effect of price changes, real GDP gives you a much truer picture of actual physical production and economic expansion. When policymakers and investors are looking for healthy growth, they are looking at the real GDP rate.
And that growth isn't a straight line. The economy moves in cycles. Recession versus expansion. How do these different cycles affect asset performance?
Well, in a recession, you see contraction across the board. Sales slow down, companies cut production, and unfortunately, employment drops. This directly translates into lower corporate earnings, which severely impacts equity investments. Equity markets are forward-looking, so they often start to price in a recession long before it's officially declared.
But during an expansion phase, what tends to do well...
During an expansion, demand is high, people are spending, capital is flowing freely. This is the period where assets that are tied to physical growth and material needs tend to see a boom. So things like real estate prices, rental incomes, and commodities typically surge because construction is booming and the demand for raw materials is high.
Let's talk about the big control lever now, monetary policy. This is driven by the central bank's decisions on interest rates. This is arguably the most powerful short-term driver of the markets.
It really is. Monetary policy is all about managing the amount of money and credit in the economy. So if the central bank sees the economy overheating and inflation getting out of control, they might increase interest rates to slow down lending and consumption.
And that single action sends these immediate negative ripples through the financial markets.
Immediate and powerful ripples. You get a dual negative effect.
So what are they?
First, because of that interest rate risk we just discussed, rising market rates cause bond prices to fall. Your existing debt becomes instantly less valuable. And second, it usually causes equity markets to correct down.
And why is that? Why do stocks fall when rates rise?
For a few reasons. Higher borrowing costs reduce corporate profitability. It also dampens expectations for future growth, and it makes it more expensive for consumers to get loans for big-ticket items like cars and houses, which slows down sales for those companies.
And the reverse must be true then, when the central bank tries to stimulate a sluggish economy by lowering rates.
Exactly. An expansionary monetary policy, where they lower rates, encourages borrowing and economic activity. And this typically causes both equity investments and bond values to appreciate.
So equities see lower borrowing costs and better future profit potential, and existing bonds become more valuable because their coupons are now higher than the new prevailing market rates.
You've got it.
Okay, let's turn our attention to the government's influence, specifically the fiscal deficit. This is when government spending is higher than its revenue, forcing it to borrow huge amounts of money in the open market.
And when government market borrowings are really high to fund a large fiscal deficit, we run into a big problem called crowding out. This is a critical systemic cost that affects everyone.
So what's being crowded out?
Other borrowers. The government is essentially wading into the credit market with an almost unlimited appetite for funds, and it sucks up a huge portion of the available capital. It's like a giant vacuum cleaner for money.
So the government's need for cash acts like this massive magnet, just pulling all the available credit towards itself?
Exactly. And the consequence of that huge, non-negotiable demand for money is that it pushes up market yields, the overall interest rates in the economy, because there's now more competition for the limited funds that are left.
And that has a cascade effect on me as an investor.
A direct cascade. It pulls down the value of your existing bonds because of interest rate risk, and it increases the borrowing costs for corporations that are trying to raise capital to expand. This directly hurts corporate profitability, which is bad for your equity investments. So a high fiscal deficit acts as a systemic drag on the health of the entire corporate sector.
Wow. Okay, finally, let's look at the international picture through the lens of the current account deficit, CAD.
The CAD is, simply put, the difference between a country's total exports and its total imports of goods and services. For an economy like India, for example, which is a major net importer of commodities, the CAD is highly sensitive to what's happening in the rest of the world.
So what are the critical factors?
It's critically dependent on two major external factors: the strength and stability of the exchange rate of the rupee, and most significantly, world oil prices.
So if oil prices spike globally.
Or if the rupee weakens against a dollar, the cost of all those essential imports just surges. That worsens the CAD, which can create broader instability in the economy and in the exchange rate itself. It becomes a bit of a vicious cycle.
Okay, we have built a really solid foundation here. We know the assets, we've dissected the 7 key risks, and now we understand the macro forces that are constantly shifting the playing field. So now we can finally move into actual application investment strategy.
And the very first strategic step, before you do anything else, is aligning your time horizon with the assets you choose.
This is fundamental, isn't it? If your time horizon is short, you absolutely must use conservative assets.
You have to. Cash and cash equivalents are for very short periods where getting your money back, all of it, right away is the only thing that matters. Bonds are generally suitable for intermediate and longer periods, giving you that predictable income flow.
But for those high volatility assets like equity, the rule is strict. You need a long investment horizon.
You must give it time. You have to allow sufficient time for that compounding to really work its magic and, crucially, to smooth out the inevitable economic downturns and ride out the temporary declines in the market. Time is your single best defense against volatility.
So once you've set your time horizon for your specific goals, 30 years for retirement, maybe 5 years for a house down payment, then you can formalize your strategy through asset allocation.
Yes, so let's define that.
Please do. What is asset allocation?
Asset allocation is really the core strategy of building a portfolio. It's the process of creating a specific mix of different asset classes, equity, debt, gold, etc., that targets your required long-term returns and your liquidity needs, while at the same time rationalizing the overall risk through diversification.
And the main objective here is protection.
The main objective is to protect the portfolio against a catastrophic decline in any one asset class. The idea is that if the equity market has a terrible decade, your allocation to debt or gold or real estate should hopefully hold steady or even appreciate, preserving the total value of your corpus.
Now, we need to distinguish between the two major philosophies for how to do this: strategic versus tactical. Let's start with strategic asset allocation, SAA.
Okay, SAA is the long-term, set it and almost forget it blueprint. It's a very stable strategy, and it's uniquely tailored to your specific life goals and what we call your static risk preference, meaning it assumes your appetite for risk doesn't change from day to day.
So you decide on a fixed proportion, 60% equity, 40% debt, for example, and that's your North Star for decades.
That's your North Star. And if the market booms and your equity portion grows to become, say, 70% of your portfolio, SAA dictates that you have to rebalance. You have to sell some equity and buy some debt to get back to 60-40.
So what triggers that rebalancing?
It's triggered either when the market's performance pushes those proportions too far away from your original target, or if there's a fundamental shift in your personal life and timeline.
Like what?
The classic example is moving from the accumulation phase when you're saving for retirement to the distribution phase when you're actually retired and drawing down those funds. That is a fundamental shift in your goals that requires a strategic change in your allocation, probably towards more conservative assets.
But SAA, as disciplined as it is, has a well-known drawback. It requires you to intentionally sell your winners. You underperform during big boom times.
It does, and this is the hard part psychologically. The mechanical nature of SAA means that if your equity holdings are surging and making you fantastic returns, the strategy forces you to sell that booming asset and buy the one that's underperforming to get back to your target. You are consciously leaving potential money on the table.
So you trade peak performance for long-term goal protection.
That is the exact trade-off. And that is the gap that the other approach tries to fill. Tactical asset allocation, TAA.
So TAA is the opposite philosophy.
Completely. It is a dynamic, short-term strategy. Your allocations are made and rebalanced based purely on expected market performances. The investor, or the fund manager, is actively trying to capture those boom periods by overweighting the assets they believe will perform best in the next 6 to 12 months.
Hang on, TAA basically sounds like trying to time the market. Isn't that what most behavioral finance studies warn us is almost impossible to do consistently? How realistic is this for our listener who's aiming to be a well-informed investor, not a full-time professional trader?
That's a vital and critical question. And you're right, TAA is incredibly difficult to execute successfully over the long run. It requires a high level of skill, continuous research, and maybe most importantly, the emotional discipline to make what are often counterintuitive moves.
And the focus shifts away from your personal goals.
The focus shifts completely away from the investor's long-term fixed goals and purely onto making market predictions. For someone who is starting out, the disciplined, goal-oriented protection of SIA is almost always the safer and more reliable path toward that 30-year target. TAA carries the risk of not just missing the boom, but of getting it wrong and catching the bust instead.
So SIA protects the goal, TA chases potential market performance. Two very distinct strategic paths with very different psychological demands on the investor.
So before we wrap this all up, I think we need to quickly anchor you, the listener, in the institutional framework that provides all the safety and stability for this entire system. The confidence we have in the integrity of the markets, it relies completely on these regulatory bodies.
Right, the referees. Your sources list 5 key regulators in the Indian context. Let's quickly run through their jobs.
Okay, the primary one is the Reserve Bank of India, RBI. They handle monetary policy, control interest rates, and supervise the entire banking system. Then you have the Securities and Exchange Board of India, SEBI. This one is crucial for our listener because SEBI oversees the capital markets, so that's equity, corporate debt, and mutual funds. And their job is to ensure fairness and transparency.
And then there are the more specialized bodies.
Yes, we have the Insurance Regulatory and Development Authority of India, IRDAI, which, as the name suggests, covers the insurance sector, and the Pension Fund Regulatory and Development Authority, PFRDA, which is specifically for pension products.
And the Ministry of Finance.
The Ministry of Finance, MOS, has the overarching mandate of coordinating across all of these to ensure systemic stability. These institutions are what provide the safety rails that allow us to do all this strategic investing.
So, if you, our listener, decide you want to participate in equity, you have options. How do regular retail investors actually get access to these markets?
The sources outline 3 main avenues. First, and this is the most demanding, is direct investment. This is where you do your own research, you pick your own stocks, and you execute trades through a broker. This requires a lot of time and a lot of expertise.
Option 2.
Second, for people with more capital but maybe less time, there are portfolio management services, PMS. These are personalized, professionally managed portfolios, but they usually have a high minimum investment amount.
And the third option, which is probably the most accessible for the typical strategic investor.
That would be equity mutual funds. This is where you pool your money together with thousands of other investors, and a team of professional fund managers handles all the asset allocation and security selection for you.
So it offers instant diversification and professional management without needing that daily time commitment.
Exactly. It's the easiest entry point for most people.
Okay, finally, let's look at 2 specific accumulation tools that the sources highlight for their safety and efficiency. Let's start with bank fixed deposits, FDs. We already established they're vulnerable to inflation, but why are they considered so safe from a default perspective?
They're safe because of something called the Deposit Insurance and Credit Guarantee Corporation, DICGC. This is a vital safety net.
How does it work?
Each individual depositor is insured up to a maximum of 5 lakh rupees. And this is the key detail. This insurance covers all your deposits, savings accounts, fixed deposits, recurring deposits, and the interest held across all branches of a single bank, provided it's held in the same capacity.
What does in the same capacity mean?
It means, for example, your individual account is separate from a joint account you might hold with your spouse. Each of those is a different capacity and gets its own separate 5 lakh insurance limit. So even if the bank itself faces major financial trouble, your principal and accrued interest are protected up to that limit.
That's a huge comfort. And what about the National Savings Certificates, NSC? What specific feature makes them so suitable for the accumulation stage of retirement planning?
The NSC is designed specifically to maximize that compounding efficiency we were celebrating at the very beginning. Its structure dictates that the interest is compounded annually, but, and this is the critical part, the total accrued amount is accumulated and paid out only on maturity.
So you don't get any interest payments along the way.
You get nothing. And because no periodic interest is paid out to you, you entirely avoid that reinvestment risk we talked about earlier. The full compounding potential is realized uninterrupted over the entire life of the instrument. It's a clean, efficient, and focused accumulation tool, perfect for those defined long-term goals.
We have covered a massive amount of ground today. We've moved really quickly from the necessity of investing all the way to detailed strategy. We established right at the start that inflation is the enemy, forcing us to move beyond simple saving. And we saw that incredible example of how compounding can reduce your personal savings burden by 85%.
It's an amazing figure. And then we analyzed the anatomy of risk. We understood why equity's high volatility demands a long horizon, why debt is fundamentally defined by credit risk, and why the illiquidity of real estate makes it a very long-term commitment. We also tried to demystify some of those complex mechanisms like duration and the elegant protection that you can get from inflation-indexed bonds.
And we mapped out those powerful forces of the macro world, how rising interest rates punish both bond prices and equity earnings, and how high government deficits create that systemic drag on the whole economy that we call crowding out.
And that entire journey from top to bottom reinforces the single main objective of investing, allowing the returns your money generates to contribute significantly to your final goal. And the only way to do that is through disciplined, strategic deployment of your capital, which of course brings us right back to that crucial philosophical choice in portfolio strategy.
Right. We discuss strategic asset allocation, SAA, as the ultimate goal protector. It's the long-term defense mechanism that ensures you stay on track, even if it means you have to mechanically sell out of a market boom.
And then we contrasted that with tactical asset allocation, TAA, which aims specifically to capture those boom periods, but it requires you to try and predict the unpredictable movements of the market.
And this is where we want to leave you with a final thought, connecting that cold, hard discipline to that very human desire for more.
SAA protects you from disaster, but it also requires you to intentionally underperform the peak of a booming market by selling a successful asset. TAA is the strategy designed to try and capture that peak. The question for you to consider is this: how do you personally weigh the fundamental need for goal protection, that cold predictability of SAA, against the very human, very powerful psychological pull of trying to maximize your performance and capture those market upswings using TAA?
Where does your long-term discipline meet your short-term desire for that maximum market opportunity? That is the strategic decision that will define the rest of your investing journey. Thank you for joining us for this deep dive into the fundamentals of financial markets.
We encourage you to keep learning, keep asking these questions, and keep building that resilient, goal-focused portfolio.